Welcome into this video here. Today we're going to talk about how to take counter trend trades without range 2 and when can we take them and when can we not take them. So basically, let me start off with saying we got to know what a trend is first. And we got to know what the trend is first because you got to know what counter trend means in general. So basically the trend is based off of the 4-hour and daily time frame. Mostly session to session wise, we use the 4-hour time frame to really go in and look deep on how could this next candle look in this one session. Like if you trade London session, we look at the 4-hour time frame, see like if you see a strong bullish candle with a lot of clean range to the left, we assume that the next one could be a bullish one too. So we have a higher probability of going up there. So the daily time frame is more used to say if we, let's say we're in New York time frame or in New York session, and we have already created that top weight for the daily and it's moving down and all of that. And then we see that we get a resistance off of the 4-hour time frame because that could lead us down off of the daily time frame and the 4-hour time frame. So that's mostly later in the day, but we can use it. We can use it in all sessions too, but mostly we gotta look deep into the 4-hour time frame, and that's what I'm referring to as trend in this video here. So personally, from data, I haven't really seen that good results from just going against the 4-hour time frame, let me be honest. Because like, let's say we have a 4-hour time frame that looks like this. So this is the 4-hour candle right here. So let's say that current candle right now is coming down here. So off of knowing trend and off of just knowing how to identify the trend off of the 4-hour time frame, let's say that there's clean range to the left too. We know that this green candle right here is basically our trend. So our trend is bullish. Let's say the daily is bullish too in this example here, but let's just focus on the 4-hour. So the 4-hour is pretty bullish. We're coming down on the current one to create that bottom wick right there. So we have created that bottom. We have a small high too. So we expect at some point that this candle will return and come back up. So when we have those 4-hour time frame that's bullish, the previous one, and we're coming down for that bottom wick, some people might think that we're moving down and we could actually see a move, actually coming down there, and maybe breaking previous lows and just being bearish on the day maybe. But the thing I see here is, let's say we have a range here. This is the 15-minute time frame here. So let's separate those two and say that this is the 15-minute here right here, and this is the 4-hour time frame over here. So basically we have the 4 to the left, we have the 15 to the right, and let's say that we have a range right there and we begin to close below. So what we'll see is a lot of sellers are probably having their sell stops right at this low here because they see a breakout candle. And let me be more exact. So basically we have a candle coming like this, and then we have a previous range that looked like this, something like that. So we had a support there and we're closing below. So what we'll see now is basically candle closing below, people having their sell stop on the break of that low, but that's typically where the liquidity sits. And we need liquidity. There's coming a video out about that too. But we need liquidity in our trades too. So basically this candle, what we'll typically see is it drives, but it don't drive that much because we make maybe a top wick there and it drive down, breaks the low, but suddenly it comes back up and begin to break this high here. And when we break that high right there, we have the sellers activated in the game here. Like we have the sellers activated on the break of that low right there. So this will turn into a support, and now we can take beautiful buys coming back up here to really follow the trend. So that's why we don't want to go against the 4-hour time frame just like that. When we have a bullish 4-hour, we won't take sells just based off that first breakout right there, or like the first resistance sign of resistance here. So basically what we typically see is this. This is what we typically see on the charts when we're going against the trend, that some people get faked out somewhere. This is a clean example here, but it can go along a lot of ways. But this is like one example out of many. And this is just a simple example of how we could see that fall being so bullish. We're coming down for that bottom wick. A lot of people don't think about that. So they go into the lower time frame and see, okay, we got a breakout here. And now that we have the breakout, they see or they get stopped out because they are activated on the break of that low, and we're moving up here. because of the 4-hour trend. So I got a video on how to avoid fake outs. I highly suggest that you watch that too. It's popping out on the screen right now. And yeah, that's a very good video about how we avoid fake outs and how, just in simple terms, how we avoid fake outs in general on the charts here. So yeah, the how we really can use range too. Let me remove all of this actually, and let me draw something else here. So let's say that we want to, we see price coming down here on the 4-hour time frame. We have tapped the resistance before right here, and let's say that the 4-hour time frame is looking like. Let me draw a little range here off of the 4-hour time frame that could be happening here. So we got the 4-hour time frame tapping somewhat of a support or resistance. I mean, sorry, a resistance up here. And we've seen previously before that we begin to go down after tapping that resistance. So let's say that the 4-hour time frame is coming up right now, and and this is basically the candle. Wait, sorry, let me get this here. And sorry, just a second here. Let me draw these candles, right? So, okay, so let me say like this. We got a resistance, just a clean example here of like a normal range, on the 4 time frame. So what we typically see is that we have some resistance here off of the higher time frame, like the 4-hour in this example. So this is really our range right now. Let me draw this, this is the 4-hour time frame. So we've seen previously that candles have come up here and then begin to come down. We've seen this candle come up here and then begin to go down at the next candle. So what we see now is basically our 4-hour time frame is bullish. So this candle is bullish, and follow me here because this is a little more advanced type of concept here, and it's totally all right not to go against any trend when we have a 4 that's still bullish, but we can, in range in higher time frame markets here, we can actually go against the trend if we do have these type of things here. We got a resistance up here, we got a candle that's bullish, and we want to take sells here. Or it's not that we won't, but it's just that we see the pattern come up and we can't take sells. So let's say that we got a bottom wick and we've seen this candle begin to move up. This is the 4-hour time frame, and the current one is this one I'm drawing right now. So we're coming up to resistance, and right now we can say that this candle is right at resistance. What we typically see on the lower time frame is some candles moving up to a resistance level just like that. So we'll see a pretty often we'll see a pretty huge move up coming up to that resistance on the lower time frame too. So let's say this to the right is the 15 time frame, and we'll come up to that resistance right there. So we'll come up to resistance on the lower time frame, and we'll come up to resistance on the higher time frame. When we're at resistance on both the higher time frame and lower time frame, and the 4 was moving up to resistance like previously, we can say that, and maybe the daily is doji, or the daily is the previous one is bearish, and we're coming up to resistance. That's even better. So let's say that the daily here is, I'm drawing it down here to the right. Daily is basically bearish too. So let's say the daily closed bearish here, and we're coming up to make that top wick, and that top wick is basically this resistance. So the previous top wick you see at the daily, this one, is basically this one. Simple as that. So we got to tell a story from time frame to time frame. I got a video on that too, how to do an analysis, and that's one of my first videos actually. But yeah, that's I assume that you watched it, but otherwise, I'd highly suggest to watch that too if you don't understand how to create like a story from time frame to time frame. But basically, this is what we're talking about not using the range too when we have these kind of examples here. So we gotta dive a little deeper, and you might have to watch this a few times before you understand it. But the daily, let's say, has a structure to it. The daily has candles that make in top and bottom wicks. I mean, if you're bearish in the daily, we're moving up on the 4 time frame. This is the previous daily high up there. We can actually say that, okay, maybe we have created that top wick on a daily time frame for us to begin to move down here with the 4-hour time frame. So this is one of the examples that we can actually take the onion, or just basically sells off resistance as we call it, off of this candle that we see up here. So basically, some of the signs we gotta see is basically, a wick. Oh, sorry. Wait. before we get that resistance, that's probably used or being shown as a wick here of on the 4 time frame. So we wick up into that area. We wick up here and we have a top wick being created on the 15, or maybe this is the 15 or 30. So you can use like both time frames here. But we get a top wick, we break the previous high, which means that buyers are activated. So they buy high. We tap resistance, they don't see that. So now we can basically get a top wick on this candle and go aggressively short on this candle here. So that's really how we can use counter trend trades without range 2. But it takes some time to understand. Like it takes a lot of time to grasp because you gotta gather some data first, and it's not just typically this oh sorry, wait, let me get the arrow here. It's not typically just this example here you'll see. We dive very deep into this topic here too in the Clubhouse, and for more advanced educational content, we have the Clubhouse, which is our community of traders supporting each other, and daily live streaming. We got weekly webinars. We have much more in there. So I hope I'll see you in there. And if you're already there, type TTE Clubhouse down below in the comments. I want to see who is in there already. And yeah, this was basically it. It's basically a more advanced concept. We dive a lot deeper in like concepts like these in the webinars and all of that in the Clubhouse too. But yeah, short little video about how to take trades without range 2. So yeah, I hope I'll see you in the next video. That was all for today, and I'll see you in the next one. See ya.